Hello traders, in this video I'm going to show you how to use liquidity sweep candlestick using time frame so that you can trade the higher time frame using the lower time frame as your entry point. We will also provide you with some examples when we move forward with this video. I'll try all my best not to gatekeep any information. So let's begin with the video. In this video, you're going to find liquidity leg to be swept using the high or the low in the higher time frame. And then also in the higher time frame, we are going to find candlestick to be used for reversal in the lower time frame. And also we are going to cover retracement area levels. And then in the lower time frame for entry, this higher time frame will only be used for analysis. And then in the lower time frame, we are going to use liquidity sweep with proper analysis, including maybe fair value gap or imbalances. Confirmation candlestick must also sweep the liquidity. You have to understand that this is going to be some sort of a trading strategy, but it's not a full trading strategy, but it's going to help you at least to understand how to trade the market very easily and also to be able to enter the market without any hesitations. So let's begin with the first example over here. We have, let's say, a high around this area, and then we have a higher low, and then we have a higher high here. So in this area is where we will be looking to make some short positions, because price is likely, after making a new higher high, price is likely to reverse to the downside. And also sometimes the market can be complex. Let's say right now you see this lower high, you think maybe this is a break of market structure around this area, and then price shoot to the downside and then start to reverse after breaking this lower low, and then price start to shoot to the upside. So in this case, that means we'll be looking to enter our markets around these areas. And also I want to point out is that sometimes price can do something like this. It can also make this low here, we have this low, and then price break to the downside, breaking this. But here is where you should be looking for price action. Sometimes here you will find only bearish candlesticks around these areas here, and then you will find a bullish candlestick here. That's where you should analyze the bullish candlestick behavior around this area. Even around this area, you should also be looking for a bearish candlestick around this area to trade the market to the downside. Even, let's say we have this low here, and then price breaks it around this area. That means you'll be looking for price action around this area here, and then look for a candlestick that manipulates the previous low. So that means in this area you'll be looking for the market to do something like this, and then you'll be having only bearish candlesticks around this area. But once this bullish candlestick here appear, you have to make sure that it breaks the previous low before it can close bullish. So let's move on to a more practical example or more complex one. So in this area, we can literally see that we have HOP price action, but then suddenly the market decide to shoot to the downside. Maybe let's say this is your higher time frame demand zone around this area, and then price shoot below the your predicted demand zone, and then price suddenly shoot to the upside. Your analysis was wrong, but your trigger areas was very wrong. You joined the market very early without even waiting. So that means in this area, you have to wait for the market to make those manipulations levels before you can enter the market. So you don't have to rush to enter the market, so you have to wait as always. And then in this case, we can see that we have a high, Most people will be looking to enter on this area, and then they will put their stop losses above this here. Let's say this is your higher time frame supply zone here. Then most people will be looking to enter short around here. They will eventually, most of the time, they will do something like this. They will find a zone around this area, and then price is likely to shoot to the upside and then hit the stop loss around this area, and then this is where you'll be looking to enter the market. You don't have to trade around this area here. You have to wait for this, because price is likely to do this. If you have noticed, most of the time your trades are always in a stop loss. That's the motivation of this video. This video is going to help you to avoid those stop losses as always. So let's move on to more practical examples of candlestick patterns that we should look for in the market. Here we can see that we have a bearish candlestick. This one is an aggressive bearish candlestick, and then we have this bullish candlestick here. Here we can literally see that we have this low, and then we have this low, and then price closed with a bullish candlestick around this area. So that means from here, this low here, you will wait for price to break this low around these areas here, and then you will wait for price to close bullish. But sometimes you can still have a double confirmation. If you want to do double confirmation, then you have to watch the video till the end so that I can show you the examples of double confirmations. And we can literally see after this bullish candle here, we can see that the market made a bullish candle close, and then the market shoot to the upside. Let's say this is your daily time frame. That means in the lower time frame, you'll be looking to enter longs around this low here. This low will be used to enter long position to the upside. And also, if you enter on this area, when the market moves to the upside, you can still put your trade to break even because price has already manipulated this low here. So price is likely not to come around this areas here. This price point price is not really gonna come until it breaks new highs here. So even if you enter here, let's say maybe you are in the weekly time frame, and then you enter maybe, let's say, on the 4 hours or maybe 1 hour. When the week ends, you'll be looking to close your position around here, because I know most people won't even try to hold a trade for 2 weeks. Okay, so let's move on to another example so that I can show you around this manipulation areas. Here on candlestick pattern 2, we can see that we have a bearish candlestick and then a bullish candlestick. Here we can see that we have a low, and then we have a low here. But price, you can see we have a low around this area, we have a low here. But if we can look clearly at the price action, we can see that this low here and this low here, price broke this low with a bearish candlestick, but this next candlestick is bullish. And also we can see that there was no manipulation before we can see price shoot to the upside. So that means we had this move to the upside, and then we have this move to the upside. What we need here is this high. This high here is this high here. Okay, and then we have this high. So this is the example, and then this is the estimated example that we need to see in the market. We have this high is the same high as this one here. Then on the next candle, before the market can be bearish, we need to see a spike to the upside before we can trade to the downside. Because we don't have that here, so that means this analysis will be invalidated. So then from here, right now, we have a bullish candlestick here, a low and then a low around this area. But we can literally see that this bullish candlestick did not trade below this low here. So that means also this one will be avoided, even though price was shooting to the upside. Okay, so let's move on to another example. And also, after watching this video, you have to go and also find these candlestick patterns in your chart so that you can at least understand them properly. With better backtesting, this thing will be much easier for you to be freely. You'll be much more advanced than someone who's not backtesting this thing. From here, we can see that we have a bullish candlestick. Price traded above this bullish candlestick's high and then close bearish. So that means we will be looking for the market to trade to the downside. From here, we have a high, and then we have a low, But price, from here, we can see that this high and this high. So that means you'll be looking to enter short. But the market decided to be bullish after closing bearish. This is what we call a double confirmation. We have the first high that trades above the first high here. Let's call it this number 2. But then price made some few highs in here, Then we have the last high here that breaks above this high here. So that means right now, let's say this one has failed. You'll be looking for the market to at least confirm with this one. So let's say maybe you don't want to use the first confirmation, then you'll be looking to enter on the second confirmation. Okay, this is what you should be doing. Okay, let's clear everything. From here we can see this one has failed because we'll be looking for the market for, let's say maybe for price action not to trade above this high here, but price did something like this, and then it broke to the upside and then closed bearish here around this area. So that means this one is your double confirmation. But then we can also, let's say for now, we can see we have this, and then we have this bullish candlestick here. It traded below this low here, and then the next candle, and it also closed bullish here. So that means you can be looking, you'll be looking to enter longs around this area here, and then for price to shoot to the upside and then breaks this high. If you understand price action properly, you will always find this kind of setups. Sometimes it can be twice, sometimes it can be once before price action can shoot to the downside. So from here, let's look at this price action alone here, because we can already understand this one. So let's look at it. We can see from just looking at the two candlestick patterns here, we have this high of a bullish candlestick, and then we have this low. We can see we have this high. We have this high here. Price traded above, let's say maybe we can just write this note here. Price traded above the previous bullish candlesticks high here, and then it closed bearish. So that means this candlestick can also be your confirmation. Okay, so we can see after price has made this candlestick, price just shoot to the downside. But then if let's say we are on the daily time frame, we'll be looking to enter short in the 1 hour or maybe 30 minutes time frame. So that means you'll be looking to catch this candlestick in the 1 hour. Most of the time you'll find entries when price shoot to the upside before. That means in the lower time frame, this is your entry point, and then the market will just shoot to the downside. That's all that you should understand from this video. So let's move on to more examples. We have this bullish candlestick here. I mean, we have this bearish candlestick here, and then we have a bullish candlestick. But then this bullish candlestick did not trade below this low here. So that means we avoid this price action from here. We have this low here, but this bullish candlestick did not manipulate any low. So we can see that's why price shoot to the upside. But then this bullish candlestick price, we can see that right now we have a high here, and then price closed bearish after trading above the bullish candlestick's high and then closed bearish. So that means price will eventually try to shoot to the downside, because here we don't have any confirmation, but here we have a confirmation because price traded above this high, but price here did not trade below this low here. Okay, that's why in the lower time frame you'll be looking to enter short around this area here. This is your short areas here, and then from here I think maybe you understand the basics of using this candlestick in the higher time frame. So in the lower time frame, that means you'll be looking to find the similar patterns so that you can enter the market to go short. So let's look at another example. And also we can see from here, this is double confirmation. Let me explain from this one here. We have this low, and then we have this low here. But then we have this bullish candlestick, and you can also see price traded below this bearish candlestick's low. And then we have the low, So that means there was no price action that traded below this lows here, or below this low before it can close bullish. And then we can see this bearish candlestick here. It traded below this first candle and the second candlestick's low, the bullish candlestick's low. But then the next candle also traded below this bearish candlestick low and then closed bullish. So that means we have the first confirmation, which is this one here, and then we have the second confirmation around this area. So that is why you see price pushing to the upside after making this candlestick here. And mostly after second confirmation, price is likely to shoot to the upside very aggressively. And then if you have recently watched my previous videos, you will understand that most of the time the engulfing candlestick likes to retrace around the previous candlestick's open. From here we can see that price, after making this bullish engulfing candlestick, price came to this area. So that means here, this is where you'll be looking to enter longs in the lower time frame. So from here, this is your double confirmation candlestick pattern. So let's look at this one here. We have a bullish candlestick, we have a bullish candlestick. We have a high here, and then it closed bearish. But then we didn't want to use this one. We want to use double confirmation. So that means you will wait for the market to make another bearish candlestick that trades above some highs here. So we can see that we have a high here, and then we have a high here. This was the first confirmation. But on the next candlestick, we need to see a candlestick that trades above some high and close bearish. And we can also see that price traded above this previous high here and then close bearish. And also, as I said before, is that after price made a double confirmation, price is likely to shoot aggressively. And also we can see the same thing that is happening around this area here. We can see we have a low, price here traded below the previous bearish candlestick's low and then close bullish. But we don't want to use this kind of moves. We want to see another bullish candlestick that trades below some low and then close bullish. So let me explain. We have this low, and then this is your first confirmation, because this bullish candlestick here traded below this candlestick's low and then closed bullish. And then that means we have this low. This next candlestick here did not break any low, but then it closed bullish. Then we wait for another candlestick. It closed bearish, but then we have this lows here. And then we have this candlestick. It traded below this low here, and then it closed bullish. That is why you see price never stopped to be bullish to the upside. That is your double confirmation. Okay, so that's all that you need to understand. But before we can move on to a more practical example, let me show you another example so that you can at least understand. We have this one here. We have a massive bearish candlestick to the downside. Then price traded below this low here and then closed bullish. So because we want a double confirmation, we'll wait for some low. We have this low and then we have this low here. Price then, it came down, it opened, came down, and then traded below this low here, and then it closed bullish. So that is why you see the aggressive move to the upside. This is almost the same thing, but is kind of different, but it's just a retracement. Here we can see that we have just a small candlestick closed with an bullish engulfing candlestick pattern after prices traded below this low here. And then the next candlestick is just shoot to the downside, coming to this open of this bullish candlestick here, and then it shoot to the upside. This one, maybe, let's say maybe you are in there 4 hours. If you move on to the 3 hours time frame, the price action will be more clear. Maybe you'll find something like this here. This one is just complex double confirmations. We can see that we have a high, a bearish candlestick that traded above this highs here. But we need some price action. We need another confirmation here. So that means we have this one here. And then that means we will wait for price to trade above this candlestick here and then close bearish. We can see from this bullish candlestick, it traded above it, but it did not close bearish. Then the next candlestick traded above the high and then close bearish. That is why you see price action shooting to the downside aggressively. This is not the first example. We have another one here. We have this bullish candlestick around this area. Then price traded above it and then closed bearish. The next candlestick did not break any high, but it closed bearish. and then we have a bullish candlestick. It did not trade above any high, but it closed bullish. So that means we're still waiting for price to trade above any high around this area and then close bearish. We can see it from this candlestick. It traded above all this 1, 2, 3 highs and then close bearish. That is why you see price action moving to the downside very aggressively. So in the lower time frame, you'll be looking to enter around this candlesticks here, around this first candlestick here, and then you trade to the downside. So let's move on to an example here. We have a simple example here. We have a bearish candlestick and then we have a bullish engulfing candlestick. And also this bullish engulfing candlestick here, it traded below this low here. And right now we are on the 1 hour time frame, and this is your bullish engulfing candlestick. That means in the lower time frame, we'll be looking to enter longs around here for price to shoot to the upside. Maybe let's say targeting this high or this high here. So let's move on to the lower time frame. In the lower time frame, we can see that we have this 5 minutes time frame, and then we can see that price already traded below this low, and then we have this low, and then we have this high, and then we have this low here that was taken out by this price action here. And if you look closely, you can see that the bullish candlestick around this area, it traded below the previous bearish candlestick's low. So that means price is likely to shoot to the upside. So let's see how price has moved from here. We can see that price never stopped to shoot to the upside. It just shoot to the upside very aggressively. And then in this area, you can still find some minor entry points from here. And sometimes, let's say maybe you just open your charts and then you find this low here, and then you find price action like this. And then you see this candlestick here. Price, you can literally see that it has traded below this low. You can still try to enter here when this candlestick closes, or maybe on the retracement candlestick, and then you put your stop loss around this area. Wait for price to shoot to the upside. Also here you can say maybe this is your let's say maybe this is your demand zone, or maybe you can say maybe your order block. Then you can see that price traded below this massive bearish candlestick low and then close bullish. You can still enter here and wait for the price to shoot to the upside very aggressively. So that's all that you should understand from this example. So let's move on to example number 2. I believe we are on the daily time frame right now. Mostly this kind of patterns here, you'll find them in a trending market. And also please always use the lower time frame for your entries, because it will give you a much proper risk to reward on your profit. Maybe you'll be risking less, but for a huge potential gains in the market. So let's look at this price action here. We have this bullish candlestick here, and then we have the bearish candlestick that traded above the previous candlestick's high and then closed bearish. So in the lower time frame, we'll be looking to enter short here so that we can catch this candlestick here and for price to shoot to the downside. For targets, you can target maybe the lows, the previous lows. Okay, so let's move on to another example in the lower time frame. We can see from the lower time frame, we can see this is the previous high, this is the low here, and then price shoot to the upside, and then it shoot lower and then closed bearish. So from here we can see that price is making something beautiful around this area. We already have the higher time frame, confirmation. Then in the lower time frame, we still have to find the lower time frame confirmation. So from here, let's look at price action from here. We can see that we have a bullish candlestick here, and then price traded above it, and then it closed bearish. So that means we will just enter, put our stop loss here, or maybe wait for a retracement, or maybe enter the lows, or maybe the retracement, so that you can enter short. So let's look at how price action behaved. We can literally see that price action was shooting to the downside very beautifully. So there is nothing that you should maybe try to confuse yourself with. And because this is a trending market, we can still see the same behavior around this area. Prices shooting to the downside. Even though if you try to go along with this candlestick here, because it traded below this low here, you'll be stopped out. Okay, stop loss will be hit. But then let's say maybe you saw this candlestick, you enter, and then you saw this one, and then you enter, because your stop loss is around here and your stop loss is around here. For the short position, for the bullish position, your stop loss will be here. So that means you will win and then lose, but the win one will be in profit, and then it will give you the loss position. Enter here, market shoot to the downside. That's all that you should understand from this video. So let's move on to another example. We have this example over here on the 4 hours time frame. You can see price was shooting to the downside, but then we have this low, and then price started to be bullish. Then on the next candlestick, price traded below the bullish candlestick's low, and then it closed bullish. So this price action here means that price was very bearish to the downside. It came up, made a low, and then it shoot to the upside, because most people will be looking to enter long around this area here for the market to shoot to the upside. But then this price action was like this, broke this low here, and then right now we'll be looking to enter long. So those people who entered long here, who put their stop losses around this area, this low on this low here, will be eventually stopped out. But then because you are looking at this video right now, you will understand that no, I'll wait for the market to give me a proper bullish entry before we can see the move to the upside. So what it means is that you'll be looking for the market to trade below at least some lows before we can see price action to shoot to the upside. So let's look at the lower time frame. Because we are on the 4 hours right now, we'll be looking to enter longs in the, let's say, maybe 15 minutes or the 5 minutes time frame. So let's move on. Right now we can see that we have this low, the first low that was created in the higher time frame and then closed bearish, is this one here. And then we have this second low that was created and closed bullish. Because now we don't have any candlestick that traded below any low, we will just wait for the market to make a bullish candlestick that trade below this lows here. And then we can see price making the low here, and then it shoot to the upside. Then the market closes with a bullish candlestick. So that means right now, those people who entered longs around this area here will be in a loss. Okay, because someone will say this is a break of market structure, and then they will try to enter longs here, but they will be stopped out because you have waited for the market to at least trigger something. You can see here that price action was very aggressive to the downside. Here we can see that price action was very aggressive to the downside, and then price shoot to the upside again, and then lastly we can see that price shoot to the downside again and then closed here. This is where we are looking to go long in the lower time frame. And we can also see that price action traded below this bearish candlestick's low and then closed bullish with a bullish engulfing candlestick. So that means here we can also try to enter long here on the retracement, or maybe on the close, or maybe the retracement. So from here, so that means we'll be looking for the market to do at least one of those, and then our stop loss will be around this area here. This is your stop loss. Maybe you'll be targeting this high, maybe this high, or maybe even the higher time frames high. So let's look at how price action behaved. We can see that price action was just moving to the upside very nicely. So that's how you should always try to do things in the market. And also another thing that I want to point out is that we can also see after price has made this here, let's say you want to make a double confirmation in the lower time frame. we can see that price traded below this low here. This is your first low. We have this low, we have this low, we have this low here. But then we have to wait for price to trade below another low and then close bullish. And we can see that this low here was taken with this candlestick here. You can see we have a low here. And then price also closed bullish. So this is your double confirmation. So that means you will enter again here and then put your stop loss here. You put your stop loss around this area, you enter long here. Because we have the first confirmation here. This is your first confirmation. This is your second confirmation. Okay? So that's how you should always do things. It will be much easier for you if you go and backtest after watching this video. And also give this video a like and also subscribe to the channel. And also follow us on Discord and Telegram so that you can get weekly trade setups. So let's move on to another example. We can see right now we have this candlestick here. But then we don't know anything. We just see a bearish candlestick. This is a daily time frame. Someone will say the market is still shooting to the downside. But then if you start to read price action from this area here, you will see it clearly. So let me show you. We have this first candle. Let's say this is your first candlestick. This is your second candlestick. This second candlestick here is your confirmation. Let's say this is your confirmation number 1. So that means we'll be waiting for the market to trade below this low here, or maybe this low here. Then we have this low here. But then on the next candlestick, we can see that we have a low, but then price closed bullish. That means right now we have the second confirmation here. So price is likely to shoot to the upside because we have a double confirmation in price action. So for now, let's see from here, and we can also see that every bullish candlestick traded below the bearish candlestick's slow. This is your first confirmation. This is your second confirmation. And also, let me erase this because right now we can see that we have the confirmation here and then the second confirmation here. Even here, we still have the second confirmation. Let me show you. It's pretty much easy to understand. We can see that we have a bearish candlestick and then a bullish candlestick that traded below. Let's see here. From here, we can see that we have a 1 and then we have a 2. Let's say we can bundle this up and say first confirmation. First confirmation. So that means we'll wait for the second confirmation. Let's see, we have this 1 and then a 2. This is your second confirmation here. So you can see even here we still have the second confirmation. But because let's say we have missed this, right now we are focusing on this. That means this one we can also call it a third confirmation. But because let's say we don't see the same things in the market as always, so right now I will focus on the first confirmation and the second confirmation, because some of the traders won't even see this price action that is happening in the market. They will always focus on this one here. So from here, guys, so that means we'll be looking to enter longs in the lower time frame. So let's look at the lower time frame. The lower time frame, you can see this is just a messed up chart here. So let's try to enter the market here. We have this low, but price did not do anything. A bullish candlestick did not trade below any bearish candlestick's low. So that means right now we'll just wait for the market to at least print out some information around this area here, or maybe around this area here. So let's look at price action. From here we can see that we don't have anything until here. You can see we have a low, we have a low here, we have this low, but then this candlestick, the last candlestick here, it traded below the previous candlestick's low and then closed bullish. From here we can see we have this low. Then the next candlestick here, it traded below the previous candlestick's low and then closed bullish. Okay, that's all that you need to understand. You have to think as price action, like you have to think about it every day so that you can at least try to understand it properly. And even from here, let's say for example, before we can see how this price action has played out, I want to show you another thing from here. We have this bearish candlestick, we have this bearish candlestick. Then this bullish candlestick traded below the previous bearish candlestick's low and then closed bullish. But then what if you try to wait for the market to give you at least the second confirmation? You can see we have, let's combine this as a first confirmation, and then we have to wait for some low to be taken out and price to close bullish. We can see on this candlestick here, it traded below the bearish candlestick's low and then close bullish. So that means you will enter long around here. This is your second confirmation, and then it closed bullish, this candlestick here. Even though this candlestick here was a little bit messy, you'll be in the market, so there's no turning back, and then your stop loss will be around this area. That is why you see price shooting to the upside around this area. So that means you'll be in this trade and then try to enter long here. So let's see how price action has played out. We can literally see, because we have the first confirmation, the second confirmation, and then the third one here, which price was just shooting to the upside aggressively. If price is shooting to the upside aggressively, you can still try to enter long around here. That's how you should always try to trade, I believe. But I hope this video was very helpful. So if you like this video, please come to our Telegram channel so that you can get your weekly trade setup. And also, if you want this PDF, you can also find it, the link in the description below. I guess I'll see you on the next one. Always use a proper stop loss and trade safe with the proper risk management. Always use a stop loss, guys. Always use a stop loss. I will see you on the next one.